Can you believe this data? 50% people redeem their mutual funds within just 1 year's time frame. This is the data published by SEBI. And shockingly, only 3% people remain invested for longer than 5 years of time period. Now you will have a natural question, Rahul, why should I stay invested? If I need to withdraw my money, I will withdraw my money. Maybe market is falling. Maybe I need the money. Maybe I am rotating my money from Indian market to, let's say, US market. Or maybe I am buying gold or silver or whatever. Guys, mutual fund only works when you stay invested. And let me prove this by example. Let's take an example of 30,000 rupees per month SIPs, and let's assume that long-term compounding returns comes out to be 12%. I'm just making an assumption here. Now see this powerful chart. It takes almost 8 years for this corpus to go 50 lakh rupees. 8 years is such a long period to build 50 lakh rupees. But guess what? Next 50 lakhs come within only 4 years of time frame. Rather than 8 years, it is now 4 years. Guess what? Next 50 lakhs comes only within 2 years, 9 months. Meaning that as you continue to hold the mutual funds and assuming the same CAGR returns 12%, then the compounding starts to work after almost 8 years or so. In fact, after 20 years, you continue to add 50 lakhs almost every single year. Now this is magic. And imagine a person who is only in 30s, by the time they reach 50s, all of this compounding will kick off beautifully, and almost every year you see the impact of this compounding. But the biggest problem is people do not have patience. They want to see immediate returns. They want to see immediate returns within a year or 2 year or 3 year. And the second biggest problem is that sometimes what happens is that you need the money. Maybe because there is an emergency at your house. Maybe because you need money for medical emergencies. Or maybe you need money because your business is slowing down. Or maybe you need money because all of a sudden you've got an unexpected bill coming your way. And that's why a lot of people withdraw their money from mutual funds and stop their compounding totally. Even if you stop compounding for 1 year, 2 year, 3 years, it has a massive impact on your portfolio growth rate for a longer time period. Compounding is all about returns on returns, on returns, on returns, on returns, on returns. That's how, and it will take few years of time, maybe minimum 8 to 10 years for the compounding to kick off. But people don't have that much of patience. They will just withdraw the money, and that's where they cause the maximum damage to their portfolios. Having said this, the problem still remains. Rahul, what if I need the money and I have my mutual fund portfolio? What do I do? Should I withdraw this money? So in my view, you should explore loans. Although loans comes with their own risks, but every business, for example, takes a loan. Why do they take a loan? Because they believe that if they take a loan, let's say at 10% interest rate, and if their business grows by 15%, 18%, 20%, 12% higher than this interest rate, then they know that this loan is actually good for them because they're taking this loan to build their business, to grow their business. Even in olden times, if you remember, our grandparents, they used to take loan. And what will they do whenever they need money? They would take their gold, but they will never sell it. What they will do? They will take loan against the gold. Why would they never sell gold? Because they know that gold prices will continue to go up in future. It's better to take a loan against the gold, and whenever they get the money, they return the money, bring the gold back home. Exactly the same concept you can apply with even your mutual fund portfolios. That brings me to option number 1, which is taking a loan against your mutual fund. And option number 2 is that you take a loan which is a personal loan. Let's now compare these two and understand what are differences in these and which one makes a lot of sense. So option number 1 is taking a loan against mutual funds. For this, I am going to Volt Money's website. Volt Money is the leader in loan against mutual funds. First thing you will note here is the calculations. Let's say I needed 20 lakh rupees of loan amount. So for loan against mutual funds, you can take a loan of 20 lakh rupees only if your mutual fund portfolio is 40 lakh rupees. Assuming you have equity based mutual funds. So in equity based mutual funds, if you have a portfolio of 40 lakhs, then 50% of this 40 lakhs is the maximum loan amount you can take. However, if you had debt mutual funds, in that case, up to 80% of your portfolio value is allowed as a loan value. Now comes the second most important part of loan against mutual funds, their interest rate. Volt Money right now is offering 10.49% of loan. I don't know when you are watching this video. I've given you the link in the description and in the pinned comments. Go and compare what is the prevailing interest rate given by Volt Money. Right now it is at 10.49%. Let us now assume that you take a loan for 3 years. You can take a loan maybe 1 year, 2 year, 3 year, depending on your personal needs. But let's assume that 3 years of loan is what I take. Now here you get two options. What is the first first option, that you only pay the interest for the next 3 years, and at the end of the third year when your loan finishes, you pay your loan amount, which is 20 lakh rupees. In that case, what happens is that your interest is higher. Of course, you will end up paying 6,29,975 as the interest, but your EMIs for the next 3 years will be relatively low because you're only paying the interest. Here the EMI will come as 17,244 rupees. Now, of course, you need the money. That's why you're taking the loan, right? So therefore, this makes sense if you can't pay a lot of money on regular EMIs for the next 3 years. Now comes the option number 2, where you want to pay part principal and part interest. That option is also there. Here, your total interest amount will be much lower. How much will it be? It will be around 3,22,829 only for 3 years. But here you are paying higher EMI. So if I show you the full schedule here, every month you are paying almost, let's say, 71,000 rupees onwards here. And this money will start to come down slowly. It's not a fixed EMI here. It is coming down. Your principal component here remains constant. As you can see, 55,556. But your interest component comes down as you start to repay your capital. But the total interest you see here is around 3,22,829. So that's loan against mutual funds. Now, before I go to personal loans, one of the biggest advantage of loan against mutual funds that is offered by Volt Money right now is that you can repay your principal amount anytime. Okay, and there are no pre-penalties. Let's say you take a loan for 20 lakh rupees and after 6 months you realize that, you know what, I have the money now, I want to pay it back. You can pay back your entire 20 lakh rupees. There are no penalties here. You pay the interest for whatever duration you've held the money for. Now let's compare this with personal loan. So I'm going to a personal loan website here, okay, and I have put in the same number here, 20 lakh rupees of loan. Here, since you're not taking a loan against mutual funds, it is unsecured loan, right? Here, typically the interest rates will be higher. It could be anywhere between 12% to 16, 18, 20, depending on your personal history. So I'm putting a number here, 16%. It could be any number, right? 12%, 13%, 14%. At 16%, if you take this loan, your EMIs will come out to be 70,314 rupees. Here the interest amount will be much higher, of course, because it's at 16%. It will be 5,31,000 rupees. Now, even if I bring this interest amount from 16% to, let's say, 10.49% and see what happens, the interest amount is coming at 339,836. Okay, compare this with Volt Money, it comes out to be 3,22,829. Why? Because here the monthly EMI is not fixed in case of Volt Money. In case of personal loan, your monthly EMI is fixed, and that is why precisely you are paying slightly more interest in case of personal loans. And getting a personal loan at 10.49%, not everybody will get it, because it will depend on the credit history, depending on many factors here, your salaries, your disposable incomes, and whether you are even eligible for 20 lakh rupees of loan or not is a question. So in my view, personal loans, if you're able to get it less than, let's say, 10%, yes, it makes sense. Okay, but if you're not able to get personal loans below 10%, then definitely you can go and explore Volt Money's loan against mutual funds, rather than you breaking your compounding, because over long term your compounding needs to kick on. It's not about whether in mutual funds you will generate better than 10.5% or not. No, it's not that. It's about getting returns on returns. Even if you disrupt your compounding for, let's say, 1 year, 2 years, 3 years, over a longer period of time, it gets added up and you lose a lot more money than you think. So whenever you need money, there are 3 options in front of you. Number 1 is to redeem your mutual funds. And please remember, whenever you're redeeming your mutual funds, A, you are breaking your compounding. Number 2, you are paying capital gain taxes. Number 3, there are of course transaction fees involved, etc. And number 4, the biggest thing is that you need to remember, once you withdraw the money from mutual funds, how likely it is that you're going to put this money back into mutual funds after you've used that money. A lot of people, once withdraw the money from mutual funds, they never put it back. Remember, the 5 lakh or the 10 lakh that you withdraw from mutual funds very well can double, can go 4 times, can go 8 times if you allow it to compound. But anyways, it's your choice. If you want to redeem your mutual funds, that's your option. Option number 2 is taking a loan against mutual funds. Go on to Volt Money's platform. You can explore this product in a lot more detail than I have explained you here, but few points that I'll make. It's totally digital. You don't need to visit a branch. You can complete your process online, and it's hardly going to take you 5 to 10 minutes to complete your online application. There is no physical paperwork at all. The loan disbursal will happen automatically and instantly in your bank account. You don't need to do anything there. The interest rate as of now is 10.49%. I don't know when you're watching this video, it might have changed. So go and check it on Volt Money. I've given you the link in the description and in the pinned comments. There is a one-time processing fee as well, which is around 1500 plus GST. Again, at the time of recording the video, I don't know when you're watching the video, check it out please. In fact, using the link below, you can immediately check your eligibility, whether you apply or not, it is your call. You can check your eligibility by simply entering your PAN card number, your mobile number. Once you enter your PAN number and mobile number, you are going to get 2 OTPs. Just enter those and immediately you can see how much loan you are eligible for against your mutual funds. So that's your second option, which is loan against mutual funds by Volt Money. Third option for you is personal loans. You can go and explore those only if you get very, very good attractive loan rates. Maybe for example, let's say 9%, 9.5, 10%, something like that. It makes sense. If you're getting it, let's say at 11, 12, 13, 14%, then in my view, that doesn't make any sense, right? In that case, it's better to either go for loan against mutual funds or look for some other options. So in this video, I've tried to explain you the logic of power of compounding and how your power of compounding gets disrupted the moment you withdraw your mutual funds or your portfolios. I hope you got educated and you learned something new in this video. If you did, request you to like this video. Let me know in the comments a simple thank you. It motivates me to curate content for you at zero cost. With that, I'm going to see you in my next video. Until then, keep rocking.